Now, by 1962, during these years, I've heard from Warren Buffett that there was so much over optimism in the markets that it led to, even when corporate earnings were dropping or not even rising, the stocks were going up and up and up, right? And that's obviously like sort of like a bubble in a way. And that was happening ever since 1960, right? During these years. So you had 61, the market behaving this way, and a lot of people bought stocks. And then until 1962, what pushed the market to like finally pop that bubble, which was already happening, but what pushed it more was because John F. Kennedy, which was the president of this time, John F. Kennedy said on television that, so it was actually an audio of this.
The President's press conference from the State Department Auditorium in Washington, D.C., April the 11th, 1962.
The simultaneous and identical actions of United States Steel and other leading steel corporations increasing steel prices by some $6 a ton constitute a wholly unjustifiable and irresponsible defiance of the public interest. In this serious hour in our nation's history, when we are confronted with grave crises in Berlin and Southeast Asia, when we are devoting our energies to economic recovery and stability, when we are asking reservists to leave their homes and families for months on end, and servicemen to risk their lives, and 4 were killed in the last 2 days in Vietnam, and asking union members to hold down their wage requests, at a time when restraint and sacrifice are being asked of every citizen, the American people will find it hard, as I do, to accept a situation in which a tiny handful of steel executives, whose pursuit of private power and profit exceeds their sense of public responsibility, can show such utter contempt for the interests of 185 million Americans. If this rise in the cost of steel is imitated by the rest of the industry instead of rescinded, it would increase the cost of homes, autos, appliances, and most other items for every American family. It would increase the cost of machinery and tools to every American businessman and farmer. It would seriously handicap our efforts to prevent an inflationary spiral from eating up the pensions of our older citizens and our new gains in purchasing power. It would add, Secretary McNamara informed me this morning, an estimated $1 billion to the cost of our defenses at a time when every dollar is needed for national security and other purposes. It will make it more difficult for American goods to compete in foreign markets, more difficult to withstand competition from foreign imports, and thus more difficult to improve our balance of payments position and stem the flow of gold. And it is necessary to stem it for our national security if we're going to pay for our security commitments abroad. And it would surely handicap our efforts to induce other industries and unions to adopt responsible price and wage policies. The facts of the matter are that there is no justification for an increase in steel prices. A few gigantic corporations have decided to increase prices in ruthless disregard of their public responsibilities. Some time ago, I asked each American to consider what he would do for his country, and I asked the steel companies. In the last 24 hours, we had their answer.
So really, JFK said it very well for me. What I'm going to say, basically, the steel industry just completely rose their prices out of greed, and there was a high amount of issues with the person getting steel, and a lot of businesses not able to get steel because simply steel prices are skyrocketing for no reason either. And the amount to produce steel is significantly less in output compared to the amount that they will gain on selling, which is that's just ridiculous. Like, so JFK is really blastering them, right? Like, that's what he's doing. He's really blastering all industrial and anyone that's raising prices for no certain reasons. And I can understand why, because during this time, this is actually when the U.S. was involved. The U.S. didn't invade Vietnam yet, but they were having a lot of tariffs and tension with with Vietnam specifically, and they also had Russia to worry about in the Soviet Union, and many of these different problems, especially with China in that time. Even though China wasn't much of a problem, China was really focusing on their own problems, because actually during this time China was facing the Cultural Revolution, so they were not worried in parts with the US. So China had to really focus in itself in that time. You can see in a time of a lot of cooperation, these industries decided to become greedy and raise the prices on steel to an irrational amount towards people that can't afford. And of course, Kennedy is blasting them. And that's for that reason, because the market did not go down because of these steel industries. They just pushed the market down when the market should have gone down before, because people were too greedy. Why? Because why would the market keep going out at a ridiculous rate when corporate earnings have been stagnant and dropping? Right. So that was actually what Warren Buffett said. I remember there was a video. I think he's 92 now. So Warren Buffett was born in 1931. Wow, he was born literally in the Great Depression. In fact, there's a video. Let me see if I can find that video.
I think the president's action on steel probably had something to do with the timing of the decline, but I don't think it was the factor which determined the amount of the decline. For some time, stocks have been rising at rather rapid rates. Corporate earnings have not been rising. Dividends have not been increasing, and it's not to be unexpected that perhaps a correction of some of those unusual factors on the upside might occur on the downside.
Well, some observers from time to time say that the stock market is a forecaster of events to come. Can you predict, or would you care to take a look at what you think this might be forecasting, the decline?
The stock market has been a good forecaster from time to time in the past. It also has been a rather poor forecaster occasionally. For example, the last 4 or 5 years, the stock market has been booming along and presumably forecasting better business, which has really not materialized. Corporate profits are not any better than they were 5 years ago, but stock prices are 50% higher or thereabouts. So maybe the stock market is really correcting a previous incorrect forecast this time rather than making a new correct one.
Well, in a nutshell, Mr. Buffett, can you give us your opinion of just exactly what happened, what caused it?
Well, there was undoubtedly some forced selling the week when the stock market hit the news. The previous week, prices had declined about 6% for the week on average. There was some stock that was forced upon the market both by margin calls from brokers and some that was forced out by improperly secured bank loans. And this in turn set up a self-generating mechanism on the downside for a while, which we may have seen the last of and which we may not have seen the last of.
Yeah, exactly. It's just what I just said. And he's basically repeating of that. Corporate earnings were staying still when the markets kept going up, and there's not much reason to be going up for the last 3 years. And part of that reason for markets to come down in this rate, like the Kennedy slide, was because of margin calls. Obviously, remember that margin calls. If you guys don't know what a margin call is, a margin call happens when an investor or a trader or a person who has a brokerage account or they buy and sell with a broker. They have a margin account, and what the margin account does is that the broker is able to give double the money that they currently have in the account. So if the person has $100,000, the broker will give you $200,000. And if you decide to put all the money into a few stocks and all these stocks come down temporarily because of these macroeconomic events, you're going to get a margin call, because a lot of the stocks have decreased to such a big amount towards the broker seeing too much risk to what the upside is, and they wanted to secure their money because they're a business at the end of the day. That in order to do that, they're going to tell you they're going to force sell your positions because they're required to do that, or else they're going to lose money and you're going to lose money. But they're more worried to lose their own money than your money, and they're going to sell all your positions that you currently have, which leave you actually losing money, right? And you're not able to catch on the good businesses that you want to do. This is why I never say to anyone that if you're investing, you never ever, and there's never even a good reason to use margin. There's no good reason. And anyone could say some technical reason. There is no good reason to use margin for investing. Why? Because no one has the physical capability, the mental capability to predict or to know whether the market will keep going up in a full 100% rate for the next few months. Because anything can happen. Like this Kennedy slide. No one knew 4 months ago that Kennedy would go out as the first president. And also this was when Kennedy was the first president to actually go in television and say this. And the first time he said this was to punish steel companies. So can you imagine that? Like the first time a president is on the television and what he's about to say is regarded towards punishing steel companies. So obviously that's going to affect a lot of the bias. And you can't predict that, right? And because of that, despite that, the markets went down. You lost a lot of your money, and you've already lost it. You didn't lose it if you sell. You don't lose if you sell. If you don't sell, sorry. because you still have the position. And if the position goes up and you're making double, well, you're not selling, you're not losing, you're making money. But you do lose money if you have margin because of margin calls. So that's why I don't use margin. And also because what he said, that according to that time, many people were on loans, which is basically the same thing as margin. It's just, that's why you never want to use even margin to an extent in the markets for investing. For trading, it could be done if you're allocating per position only maximum 3% of your entire account, not including the broker's money, just your money. That's why I talk about in the trading course, we do use margin in the trading and trading options and trading stocks. There's one trading style that I don't use margin at all, but there is one which is the swing trading. I do use margin, but I only risk about 3% of my position, because if all 10, 15 of my positions go to worthless, well, the max drawdown that I will have in my account if I'm risking 2% of my capital would be about 20%. I mean, the broker will tell you to ring up money if your account drops down by $2,500, right? And if you're day trading, you need a $25,000 minimum balance in your account. And that's the same thing with margin with not day trading. So that's why I never am and I never will get margin calls, because I don't risk at all big positions with using margin, with using the broker's money. Now, well, those were the reasons for the market to go down like that. But yet, out of all this, despite it, the market bottomed here. And let's see what happened afterwards. Market went up, like always, obviously. I think you guys know that by now, and by this nature, that the more panic, irrationality, the more likely the market's going to rebound. So you can already imagine what I'm going to say in .com in 2008 and stagflation. I find it ridiculous. Many people are just completely panicking over comparing now to the 70s. That's like a lot of people who are saying that don't even know what the hell they're talking about. There's nothing. It's like not even close to what happened in the 70s. You can't. It's like comparing an elephant to a giraffe. Like they're both tall, but they're both completely different features. They're not the same thing. And it's exactly like that. That's like comparing an elephant to a giraffe. Not that the elephant is worse, but I'm just saying that the comparison, the similarities there are nowhere close to each other. Now, the Vietnam War started in March 1965, because this is when the US invaded Vietnam, right? But actually before this, during 1962, after Kennedy, this was called the Kennedy slide, right? This was the Kennedy slide when Kennedy went on live television punishing steel companies. But Kennedy actually, after this, I think I have an article here, right? In this year, right? So let me show you. After this slide, around this time, I think it was here in September, it was a Cuban Missile Crisis. That's when the US discovered, and John F. Kennedy announced to the world, or to the US, that they found nuclear missiles in some area in Cuba. And the market just went down like 3 weeks, and it went back up. See, in a nuclear missile threat, the market went up. That's why the market, like, it comes to the point, like, there's nothing, what worse can beat that? I mean, you were talking about a nuclear threat right next to a nuclear threat to your neighbor country. Yet the market went up because it already factored it in, and the market's already been going down, right? And it's not such a big problem either. Of course, it is a big problem, but each country wants to nuke each other, right? Because if Cuba does that, what do you think the U.S. is going to do? The U.S. is going to already detect that in its way, and they're definitely going to send a nuke and completely eviscerate entire Cuba. They have the power to do that, of course. No, that'd be absolutely horrible for the U.S., but that never happened. The Cuban Missile Crisis was right here, and John F. Kennedy, okay, he died in 1963, November 22nd. Okay, so this was on a Friday. He died on a Friday. The market went down completely more. Look what happened. The market actually bottomed when he died, and look, the market went up. I mean, I don't know any other reason to keep showing you why the market doesn't react to what goes out in the outside. I mean, the president got assassinated and the market kept going up, even hugely, 90 degrees. Right when he died, a day later, the market shot up. You see, like, that's why the market has nothing to do with logic factors that could affect the economy. Like, seriously, it can't. This is why listening to economists, listening to billionaires, listening to anyone who's trying to predict and tell you what the market's going to do, it's very likely that, one, what they're going to say is not going to be effective because the market doesn't respond towards a few economic factors, because there's only so much that you can know, right? And there's many, many different reasons the market moves in a huge swing that it's beyond your comprehension and beyond what an AI can tell you, because an AI can tell you everything, but it can only give you probabilities. about this, and also there has to be a reason why they're telling you this. If a person has made a lot of money, I'm pretty sure they're very well knowing that the market does not work in a prediction phase, because they would not be making money. They would be poor if they do that. So I think they make more money in selling you, telling you that the market's going to do some sort of way so it affects your behavior, and that they'll buy cheaper and they'll be able to get a bigger rate of return later because they're able to control what's going on. And that's what about 90% of Wall Street does. Not a lot of people are going to like what I just said, but that's the fact of that. And the market kept going up from there. But I'm literally showing that there's no better reason for the market to keep moving in any direction and any macroeconomic effect. There could be a possibility. Well, the market doesn't work in a prediction way. It doesn't move 100% in a certain way because the president died and the market literally a day after went up. I mean, who in the world would want the market would be buying after the president died? Who would be? Maybe the person who facilitated his death, but not everyone. So it's not. And this is 1963. And ever since 2022, all these different things that are going to happen, you're going to see the same thing. After a bad thing, when everyone doesn't think it's going to go up, it goes up. When people are too greedy and goes up, it lightly comes down. So this is why, of course, the best time to invest is now. But if you're a person who doesn't like to look at temporary losses in your account, then get good with technical analysis, right? I teach that in the trading course that you guys should have if you got the bundle. And you obviously will know what time is a good time to buy, and you'll wait for a correction, right? But a good time to buy is always now. As long as it's cheap relative to what you can get later, then technical analysis does not matter even remotely, right? The only point about technical analysis is to somewhat ride in a possibly wave to the direction you want to go. But I'm saying possibly. I'm not saying that it will, right? Because technical analysis, no analysis can give you full. That's why this is why I don't do predictions, because my analysis is not meant to predict anything. I'm just supposed to lay out all the possibilities that I see the market can do, and whatever the biggest possibility is likely to do, well, that's the road that I go to, right? But because it's a possibility, it doesn't mean that it's going to happen. It just means that it's a possibility. It's a likely chance, but I'm also going to likely fail too on that. So people just have to switch. That's why I talk about that the market does not work. You get successful not because you have a good strategy. No matter how good your strategy, no matter how intelligent you are, none of that matters. It never matters. I don't care how smart you are. It doesn't matter at all. What matters is your expectation to go about it. And every single successful person in the market, I'm guaranteeing you, every single successful person in the market is going to tell you that the reason why they're so successful has something to do with because of the expectation they put in. There's not going to be a single person that said in the market over the long term that's sustained successful to tell you after many results to tell you, oh no, I got good in the market because I decided to buy a lot and I didn't do much of analysis, and I just wanted to make more money. There's no one says that. They had to go through different failures to factor in their brain psychologically, subconsciously, to not buy when everyone's buying and to have discipline. I really wanted to show you that because it really shows that the market does not behave on predictions. It doesn't work on anticipation, on stupid. I'm sorry, but it just frustrates me because I see many people trying to sell other people on useless data that has nothing to do with actual relevant factors that move the market. The market does not move on interest rate with division on square roots on that's complete gibberish. That has nothing to do with. That's why it's not a problem that you're smart. Like there's no problem being smart. In fact, you benefit from that. But in this field, it's good to be smart if you're a doctor or if you're a scientist because it helps upon that because it's academic. It's rules within the law of nature. The stock market has nothing to do with that. It has to do with the psychological nature, not with the physics and what chemical no, because those are facts. Those are embedded by laws, by the universe, by God, I think, about in that way. But in this, you're literally going against a person like yourself and upon billions of these type of people. So you have to think of a way what other people aren't thinking to see a route where that's how the successful route, because if everyone's failing, well, you shouldn't be repeating that same process. But out of that happened the Vietnam War. Then in 1966, the market went down. Another reason, right? Most likely has to do something in the past year, probably interest rates, inflation. It's always the reason. Okay, so let's take a closer look then in 1965, because during this year, we saw that the Vietnam War started. We've all seen that usually the market comes down based on present bad situations already occurring, or let's say consequences. So when you have bundled consequences, the market then responds with a downward trend. And that's what happens a lot of the times. Majority of the times. So you can see in this article from Yahoo Finance, during this year back in 1966, the Vietnam War was escalating, inflation was rampant, interest rates were surging and concerns over a global recession pounded stocks. So it was really inflation, Vietnam. Obviously, when you have a war, inflation is inevitable. And then also interest rates based on both inflation, which not all the time, but sometimes when you don't respond in the best manner, you do have a global recession. And recessions were very normal back in those days. Now recession, I thought about that earlier, that in recessions, the funny thing about recessions is that back in the 60s, 70s, and 80s, before the 21st century, a recession was so normal in the stock market. Now, when a person says that there's going to be a recession, people think of 2008 and the dot-com, that a big catastrophe is going to happen. That's not exactly the case. A recession has always happened. Back in the past, in the 70s and 80s, a recession would have happened every 2 to 3 years. Nowadays, everyone is terrified when it's going to rain outside. So then people try to pack their it's similar to Florida with hurricanes. People are going to pack or worse, it's like a hurricane with tornado. Let's mix that combination. People are going to pack into their bunkers with a bunch of canned food for a month or so, or 2 months, and where they can't go outside, they can't do any activities, and they just have this mass amount of fears of what will potentially happen. In the past, when there was going to be a recession, it was like, oh, well, it's going to rain outside. We can't really do much outside, but we're just going to make do with what's inside. So I think that's funny how it's different from nowadays. Whenever I see like someone say a recession, they usually have a lot of fear in their face. And I kind of just laugh because a recession is normal. It's supposed to happen. It's happened many, many, many times. Now, of course, I know the economic scenario is different from what it was in the past. But if we're talking about the 80s and 90s, in fact, the U.S. was starting to get in a better position. Right now, the U.S. is in a better position than what it was in the past, but it's topping. The U.S. has been doing better every decade, but the race of the increment of let's say better has been reducing as time has gone by. And I think that's been happening the past 20 years, in where the amount of growth with the US has started to slow down because there's only as much the US can do in a much longer term. And also because of the psychological effects that go on with future generations that haven't experienced, let's say, poverty or opportunities that they don't have. Nowadays, everyone has opportunities, right? So this is somewhat additionally, and everything that I'm just saying, it reminds me of a lot with recessions. And you can see here, ever since the 28, a recession was pretty normal for it to happen. And the markets didn't go down because of recession. The markets went down because a combination of many different bad consequences, whether that was high inflation with high interest rates and monetary tightening with a banking issue, or inflation type monetary tightening with a geopolitical issue like the Suez Canal, right? Or an oil crisis with high inflation, with GDP slowing and unemployment at its highest. You see, the market does not go down because there's high unemployment or the inflation is high. The market goes down when you have 5 things at once or 4 things at once, right? So the important thing is to always look at the long term and not accumulate bad decisions, right? Of course, it's better to not make it's better to not make any bad decisions, but it's inevitable to make a bad decision when you're faced on an uncontrollable event. So an uncontrollable event could be like COVID, right? COVID did not happen because there was a bad practice in a different country and many people report. No, it was just a virus that came out and it affected everyone in the world, and everyone had to correspond in a reacting way, right? So that's different. That's why bad situations are going to happen beyond a person's or government's control or in a person's control. But inevitably, as the human condition works, everyone's going to make bad mistakes and they're going to have to pay the consequence later. Unfortunately, the consequences sometimes have to be paid to people who are not responsible for it, like the lower income people. That's why every time when there's, for example, what happened in the Great Depression, when the Great Depression happened, a lot of people went broke, but the rich got richer because their asset values went up. You see, so it's you want to be in the right position at the time when it comes. That's why I believe in wealth. You have to become financially independent. That way, when there is a bad situation that happens, that will happen eventually, because it always happens, you will have the means to sustain yourself by the resources you've been accumulating for the past many, many years. And that's important. Those methods could be like this: investing in the stock market, investing in solid businesses, in great businesses, investing in multiple amount of these different assets. If you want, having the stock market with real estate, the most important thing is to find a stable assets that can grow at a considerable rate, much more higher than the amount of money that it can depreciate. So for example, usually the inflation, I'm not saying that this is the case, but I've seen that by average ever since I think the 40s, the 30s, the US economy has had an average. It's not every year it's had this, but it's had an average of 3.48%. So if I'm just giving you a general concept. If this will happen in the next 10 years, that means if you have $100 right now and you keep them in your bank account 10 years later, you're going to have now an equivalent worth of about $62. Now, why is that so? Well, because your money depreciated by 38%, right? Because 3.8% per year, and if that's 10 years, 3.8% times 10 is 38%. Hold $100 for 10 years, your money is guaranteed to lose by 38%, right? So the goal here is to find something that could outpace inflation by a considerable amount. So I usually think about it like try to look for a return of 1 to 10. So that means, well, if in 10 years your money depreciates by 38%, you want to look at an asset that can give you a return on your investment of 380% in 10 years. That's a safe ratio, right? Because anything can happen. Now, I don't like to use at all per year, especially in any markets, but especially in the stock market, because the stock market goes up and down. It doesn't go up all the time. There's sometimes when the market goes down for a year and you don't make sometimes the best return per se, right? But no one's making the best return in a bad market situation, not even Warren Buffett, not even an index fund. So it's a delusional to think that you're going to make a positive return every single year. So you could have the case to be very close to that, but I don't think it's very unlikely that you're going to get a positive return every single year. That's baloney. So yeah, we were talking about recessions, and that's what goes about with that. Now let's look at this. There was high inflation in the Vietnam War. The Vietnam War officially began in March 65. If we look at that date, that was right because this is 1965 year on March. It was in March. That's when the Vietnam War began, and you can see that the market corrected. It hit the 100 moving average and went up. But of course, there's always sometimes a delayed effect in what's going on economically, and that's why the stock market is not economy, because the stock market anticipates it. I'm pretty sure in this time there wasn't any disastrous decisions going on frequently. Usually the market anticipates that. Usually when the market in Wall Street is telling you that, or the Federal Reserve wants to, let's say, raise like last year, in 2022, the Federal Reserve wanted to raise interest rates a lot to fight inflation, right? That caused the stock market to go down also because of the Ukraine and then post-COVID, all these different things. And here you have inflation, Vietnam War, a fear of a recession, similar to what's happening now. This is very similar to what's happening right now. Not the same, it's not the same at all, but it's the same, it like rhymes. Because we have inflation, interest rates not as much because they're slowing the increment of rising. And people, even banks, which are market makers, are saying that there's going to be a global recession. So the market went down from this year, but the market corrected. And the reason why, I could say, no one can tell you for sure the reasons exactly why the market bottomed. Neither can I. I can't tell you why the market did this exactly, but I could tell you a high probability of so. A high probability that the market went down sharply and went up and shot back up is because during these times, remember that over the past few years, this is the baby boom age. Now, many of you might be saying like, okay, but if it was the baby boom age, then why, if we look at the Kennedy slide, why did it go down so much? Well, because you had high inflation, stocks were over beating the price of what earnings were actually producing. You had many people entering into the stock market out of greed. And also, this was the first time that a president in public television, first time in public television to actually punish all the steel companies, right? And then during this time, you had the Cuban Missile Crisis. So it's not surprising that the market went down that much despite the baby boom. But the baby boom did prove to be very strong because the market did go down indeed, but it bottomed very quick. I mean, this is just a span of 6 months. That's 6 months. I could tell you that a bear market of 6 months is very normal, and I would say it's considerably a bit low in terms of time. And look how much the market shot up a lot. From June all the way to June, so a year, it went from $533 to $732. That's a 37%. It's a 37% gain. Now, towards 65, that's what's happening now. So you had this baby boom. However, by 66, the market went down a lot, similar to these events were accumulating. I'm sure the inflation was accumulating, and prospects of inflating it was accumulating as well. That by the time it was 1966, this is 1966, in March, Vietnam War, right? And then as months went by, the government probably said we have high amounts of deficits. We need to control a bit of our inflows and outflows, like, these sort of reactions that they have afterwards, a big amount of spending. That's what happened in World War II. When the country goes to war, they have to leverage a lot, and they have to find a means to sustain their own country. Additionally, not solely, but additionally, by using the Federal Reserve, which is pumping more money, doing different sorts of monetary practices. So the market went down, and that was the cause of it, and it did go down a lot, right? So, but sometimes there's a few times that the market goes down and shoots back up and doesn't go back to that price ever again, right? So you have to think about it like that. In this case, the market did go down quite a bit, and when there was a lot of fear, right? But remember, when there's a lot of fear, there's not much more fear to be worst out of that previous fear. So if the world's gonna end, right? What other worse thing can happen than the world ending? You see my logic? That's what happens to the market. When something bad happens, it's harder for another worse thing to happen compared to the previous bad. And that's why the market bottoms so fast, and it bottoms when no one expects it to, and it shoots back up immediately because there's not much more to sell for, and everyone sold everything. That the only thing that you could do now is really buy. And so it did. On October, it bottomed and went back up. Right? This is a very normal example, per se. There's not much like complex factors that went into it. No, you just had high inflation, Vietnam War, combine that together on top with other macro factors. People have been saying probably for the past 5 years that people are expecting to have a global recession, right? And that's normal. That usually happens, right? But at the end, the market doesn't really care. It bottomed, it went back up. And then in 1967, the market went up from 67 to 68. And then by 69 was now officially the beginning, if you guys don't know this. By 1969, it was really the birth of stagflation, right? So now we're entering into a new decade where you have this crazy amount of inflation that has never been seen before since the Great Depression, right? And the reason why this high inflation occurred was because of the amount of consumption, overconsumption compared to the amount of production for the past 2 decades because of the baby boomers. Baby boomers were consuming too much to the amount of producers that would produce it, right? So it's like demand. It's like this classic demand and supply. And also because of these wars. The Vietnam War excelled that further. The Kennedy did as well. And during these different presidents leading on to this, no president has each fault, but it's just the way how it played out, because the president has to work with what they get from the other president. They have to kind of resolve all the mess that the other president left. And that's what happened over accumulation the past 20 years. Now, by 1969, you had the birthplace of inflation because of the crazy amount of consumption from the baby boomers and the amount of free leverage utilization from the US dollar compared to its gold assets. Because remember that in this time, the US dollar was still pegged to the gold. If you guys don't know that, I mean, the US dollar before, it was linked to gold. So that means if you could easily exchange your dollars to gold if you wanted to. You can't do that at all anymore because the amount of dollars out there and utilizing credit is beyond more than what you can ever produce in your life to gold. So that's why money has always kept going down, because there's actually no value there. Just think about it. If yesterday there was 1,000 calculators, like this one right here, and let's say that this calculator costs $10, right? But then next week there's now 1 million calculators. This calculator is not going to cost $10 anymore. It's now going to cost probably like $5 to $4 because everyone has it. It's not as rare. It's a less demand and need. Of course, there is demand. That's why it's there. But when there's over needance, there's not going to be the value of having it if everyone has it, because it's a tradable concept, right? If your tradable value is open to everyone, why would someone want to trade something with you if they have the same thing as you, right? That makes sense, by logic sense. If everyone has this iPhone, right, the exact same iPhone, the reason why iPhone makes a lot of money is because they keep changing their iPhones, but they keep the same platform. They evolve the same platform. But if everyone in the world had the same exact model iPhone that I have, and no other iPhones came up further, they can't produce anything. This does produce something, but if everyone has the same amount of iPhone, the price is going to come down by 50% because there's no need to keep the same price everyone has it. That's what happens to the dollar. And that happened 3 years afterward in 69. I just want to let you know that the beginning was in 1969 of the inflation because of what's been happening towards the baby boomers, really, from this overconsumption and also from the Vietnam War that made it worse because of the amount of debt the U.S. had to get into, resupply its, and the amount of resources it had to put into the war costed a lot of money to the U.S. that they were in debt. And they were leveraging too much. And you could see that in the statements that the U.S., the government, had a lot more paper money rather than the amount of gold they had. And that's very dangerous, right? You can go bankrupt if you do that. So, but of course, the government can use the advantage that a government has is that they have nearby countries. They can exchange deals to leverage with each other, right? And remember that this all really started when the Bretton Woods began, right? And that was, remember, if you guys remember, that was right at the end of World War II. That's when the U.S. became the global power. Now, in the next 20 years, the U.S. kind of has to worry about it now because the amount of, let's say, consumption to amount of production is now playing a negative impact because there's all the time uncontrollable events like the Cuban Missile Crisis, the Vietnam War, all these sorts of things. The Suez Canal, and then now there's high inflation. Yeah, the funny thing is that in 1969, that's actually when the first human landed in the moon. Yeah, the market didn't even care. The market just went down by 1969. The market went down. I know the cause though, because there was this high amount of inflation, right? And this was in 1969. I know what the cause was. It was from high inflation. If you want, we can search it. But I know that was, right, here you have it. During that period, GDP growth slowed, and the unemployment rate rose to so it basically rose by double than what it was previously. And during these years, economic growth was slow and there was relatively high unemployment, but it didn't have the level of economic contraction seen in other recessions. It began in 69 and only lasted until November. So there was a contraction. And if we look at this, it lasted about 11 months, a recession, right? So it was a recession. It followed an economic slump that began in 68. It ended in the third longest economic expansion. Inflation was rising, a result of increased deficit spending, and that deficit spending was because of the Vietnam War, and during a period of full unemployment. This recession coincided with an attempt to start closing the budget deficits. Yeah, exactly. They were trying to, I remember that. They were trying to recover and revive a bit of factors that they lost in the Vietnam War because of the amount of money they had to spend for it. And the Federal Reserve from this helped it by raising interest rates, which was monetary tightening. And whenever there's monetary tightening with unemployment and with GDP slowing and going down, you're going to likely enter in a recession. And that's exactly what happened. Although from here it says that it was a mild recession. The GDP fell by 6 percentage points, 0.6 percentage points, though the recession ended in November 1970. The unemployment rate did not peak until the next month. And then by December 70th, the rate reached its height of the cycle of 6.1%. But look at the thing that's interesting. The recession did not end until the next year by November 1970. And when did the market bottom? It bottomed in May. See? It bottomed in May. But the economy was still worse. You see, because this is pure evidence and a fact that the market does not behave like the economy. The market's separate from it because it anticipates it. So this accumulation, it's a big drawdown. I would say it's a very big drawdown. But again, this was the consequence because of the Vietnam War and what's been happening for the past 2 decades of this high amount of consumption to what actually people can produce. And those producers can't give the sufficient amount towards what the inflation, right? Because that's the inflation. When there's an issue going on economically and people want to consume more, they have to print money, right? That's what happened in COVID. Or sometimes people print money to incentivize more consumption. That's the theory behind it. But lowering interest rates too, and that inevitably makes inflation. And inflation was a accumulating problem as time went past on since 1949 until 1968 or 1969. And you had many of the Federal Reserve trying to deal with it, but none of them boldly found this problem to be problematic for the future, right? Because if that was the case, the stagflation would have not happened, right? The Federal Reserve would have controlled it a bit and controlled consumption, and not by moving interest rates away and the amount of spending with total central banks. So, but of course, it's very hard because you have to also control the way how people consume, and that's just impossible. You can't do that. So it's definitely a tough problem, but it would have been less negatively impactful if there was a bolder person to see the problem ahead during the 60s, that you didn't need to enter in this, as people call it, the 70s lost decade, really. But yeah, that's what happened in 1969. A lot of panic, I'm pretty sure, because of inflation. A lot of people losing their jobs, I'm pretty sure, because that's what I was saying. When you have an economic slowdown, you need to incentivize that by giving people more cash to buy for things. But remember what I said, when you give people more of the same thing, that value starts to recede itself as time goes on, because everyone has it more. Here's a fact. The amount of cash that's available today is much more bigger than what it ever was 10 years ago. right? And what it was 10 years ago was bigger than the one 10 years before that. And that kept going on and kept going on and kept going on, right? And when you don't have anything backing it up, but when you did have something backing it up there, it's very problematic, right? Because what led to this also drawdown, you could say, is also foreign investors. A lot of people invested, countries most of all, invested their currencies for the US's currencies in exchange for gold. But if your funds are more than the accessibility to get the gold, well, you're not going to invest as much because you know there's not much gold available, right? And that's what started to happen. And then you have really now beginners of short selling, right? People trying to short the market. If you guys don't know what shorting is, basically bet that the market goes down, right? These not all of them, but a lot of the countries I could see, because it's a logical reason, that there was this accumulation of fear, short selling. You have the short selling, but short selling of the currencies, fear of the government not able to pay back, all these type of things. And so the market bottomed in May, and it shot back up as always, despite whatever problem. And now in April, market went down for correction.